This is part number 2 of the corporate finance lecture, and it's really a corporate finance versus project finance. And here's what happened. A wonderful person in Malaysia asked me, management wants to look at ROIC. And they have this new thing. Some consultant told me that you're supposed to compare the ROIC to the WACC and evaluate every single person in the company by virtue of the fact that did you increase your ROIC relative to your WACC? And then she said, well, all these financial models have IRRs in them. What does the IRR and the project IRR and the equity IRR have to do with all this ROIC stuff? And I threw my hands in the air and I said, oh, well, the ROIC and the IRR are the same in the long run. And that was a crapo answer. And I finally said, okay, I'll try to study it a little more. And that's what I'm doing. Now, where I left off last time, I talked about this. I hope this isn't going to break here. Talked about our wonderful 1 minus G over WACC minus G formula and a little bit why it doesn't work. Here's what this McKinsey said about this formula again. We should use the return on new capital or incremental capital, but for simplicity, we assume they're the same. Technically, the return on new invested capital, RONIC, not the company's overall return. What kind of crap is this? You tell me that once you've established the return on a existing investment, it doesn't change. If oil prices go down, the return on investment in an oil field doesn't change. If I'm just reading this, when Uber destroys the taxi industry, you can say, oh, we made an investment in a taxi 10 years ago, that just stays the same. And when we make a new taxi investment, that return's going to go down, but the old taxi is going to stay the same. Total and complete, this is just absurdity. Okay, but maybe it has a little bit of a, now I'm contradicting myself, of course. Here I went and so just to let you know where I'm going, I'm going to talk about this ROIC and finish this and have a little case study on it, and then we're going to go down and talk about how to really mathematically reconcile the IRR and the ROIC. And at the end of the day, I've got bad news. As usual, it's not as easy as I said when I said, they're just about the same thing over the long run. It's not really true. Okay, so there's going to be some mathematics, a little Excel. Now, what I did with this, I said, okay, let's study Elon Musk. Everybody says, he's the maker of those electric cars, Teslas, but he really made money on stealing PayPal from you. You know, those fees you have to pay on PayPal. And this is kind of an interesting situation. Did PayPal, can it continue to grow as fast? Maybe. It's been growing really fast. And what's the return on new assets? And there's some goodwill that suddenly appeared on the balance sheet. So apparently, to make new investments, you do have to pay goodwill. That's a case where the new investments are different than the old investments. That certainly should be accounted for. Now, if you go to their financial statements, what you can do is read the, I'm just showing you some mechanics here. You can read their financials, throw them into Excel sheets. Oops, not that one. This is the thing I just showed you. Throw them in. When they come from this U.S. SEC thing, Securities and Exchange, it's kind of a pain. So you go and you open this file called, it's in the chapter 1 under Excel utilities. It's called Format SEC. And after you initialize it, you press Shift Control I, Shift Control I, Shift Control I, and then it kind of formats stuff for you. So here's the balance sheet. It's waiting a little bit, and what we're going to look at is, I suppose, the goodwill. Oh, this is 2016, 15, and 2014. Okay, and it should have finished by now, and it's not absolutely perfect. I suppose I could work on it a little more, but it puts the things together in a reasonable kind of way. And that's how I just got those out. Okay, maybe a little more. Maybe this kind of stuff here could be automated. I think it should, but maybe one day I'll work on that. Okay, and then we can see, well, in that they had a whole lot of current assets because I don't know if this is more like a bank or I think it kind of is. So they have all these funds receivable, but a big account now they have on their balance sheet is this goodwill. If you're going to grow the company, are you spending? Are you buying a company and getting a lower return? And indeed, that's what these. So I just graphed this. This is the growth they had in their assets. It's a horrible graph versus the growth they had in their revenues. Assets are growing faster. Okay. This is just another thing that says you should use this formula for the terminal value. Well, it doesn't work if the return in this node plat is different than this return. It just doesn't. Period. Enough. Maybe later talk about this. And then McKinsey says, high ROIC companies create more value by focusing on growth and lower by focusing on increasing. You can't do that. Everybody wants a high return. They just want everybody wants a high return just to say, I can get it. How in the heck? And then you have these graphs. Now, I don't know who made these graphs, but it's kind of cool where they say, here's the return versus the WACC and the growth. We want to be here. Everybody wants to be here. The worst place is here, not here. The worst place is here. They put this name because the worst thing to do is grow while you're making a lower return than your cost of capital. You're throwing money away. Said that in other situations. And here's the problem. When you're here, I don't know who put this stuff here. When you're here, everybody else wants to be here. It's not sustainable. You're going to create oversupply in the industry. And here I've got an example. Okay, and this thing that you can, this is a little bit out of order, but saying that in the long run the ROIC goes down to the growth. Well, then nobody would ever make any. Why would you be in business? It's one extreme is saying, we can make a whole lot of monopoly profit whenever we want, like Disney or somebody, or like they make you addicted to their stuff or something like that, but. You can't just say, okay, we're never going to make any profit at all. That's when the return equals the WACC. So why should we stay in business? Now, here's what happened. I'm going to discuss this case. I like to discuss this case because Stanford University did a write-up on this saying how wonderful this company was. Well, they were making a rate of return on invested capital, which is really the right one to look at because their return on equity was distorted by this. They were making 42% return, and that's right after they started their business. So it's affected by the age of their assets. That's an incredibly high return, and the question is, can you sustain it? That's really what you're looking at. And they couldn't sustain it. There's no way because it was making solar panels. I know I could never make them, but it's not that competitive a business. Now it came way down. Now they're in the EPC business, which makes ROIC even more difficult to compute. But it's an illustration. Everybody came into the business. Everybody came into the industry. They didn't have any addictive monopoly power. They weren't like Coca-Cola who put cocaine in their stuff a long time ago. They couldn't make people addicted to your stuff. Maybe that's what they tried. I'm just not saying. Here's what happened is And the financial analysts didn't predict what happened. If you look right here, they predicted the stock price would go up to 400. It went down to 30 down here, so it went down in two stages. In 2008, it had a big collapse, and in 2011, it had a big collapse. It's kind of gone up and down since then. It's increased recently, but we can't. If we didn't predict the ROIC correctly, it's going to be a whole mess. Now, here's where I'm getting to. Now, how can we reconcile the IRR and the ROIC? What I really would love to know for any company like this is how much are they making on every single investment? What's their IRR on all their investments? That's what you really want to know. The problem is you don't know IRR until you're dead. The project is dead. You don't know it until after the fact. So if you're going to report anything to investors, it's got to be ROE or ROIC. It's got to be that. And companies all should make. So the question is, is the IRR is the same as the ROIC? And my throwing my hands in the air was a disaster. It's not really the same. Now, we could, the basic the rule is you make investments when the IRR is bigger than the cost of capital, whatever that is. Okay? But here, what happens if you present a new investment to the board of directors and then you say, the ROE, don't worry, the ROE is going to be really low for about 10 years, and then it'll be higher than the weighted average cost of capital, because that's what happens because of straight line depreciation and the way we compute investments. And if it's a really big investment, you have to explain to your investors, the ROE is going to be low. Don't worry, it's going to come up later. And then what happens if you use this ROE minus WACC and you're a modern company using economic value added? But if this ROIC is completely distorted, the measurement is going to be irrelevant. So here's what I'm trying to do first, is just mathematically reconcile the return and the IRR. Now, if we take the investment balance, the invested capital balance, and then we compute the present value of that invested capital balance every single year, and use the IRR itself to do that. Use the discount rate that's the IRR, which is kind of like the IRR is reinvested at the IRR itself, the circularity in the IRR, then you do get a match. So let's show you that just for a minute now. I've got some of these down here, but we're going to make a little IRR calculation. Here's the IRR of 13.18 in this case. I just said, okay, we have an investment, and then in this case, I guess I grew it at inflation, and then we get an IRR here. And then when we do our whole reconciliation down here, when I compute the weighted average, you see that IRR down there, it's 13%. So I'm going to walk through this example. And what I did was in the disk, go to chapter 1, this time go to corporate finance models, go to the advanced. This one isn't maybe all that advanced, but it's kind of. And then you can go to IRR and ROIC reconciliation and pick up the file called IRR and ROIC. Okay, I did that without stopping the computer even. Okay, and then there are a few little things in this file. First, there's a little discussion about IRR and how IRR is just the compound annual growth rate. Here, this is our little thing where we made it 67 years, take one, let's say USD in 1950, it goes to 144 by the year 2017. You take 144 divided by 1 raised to the 166 power, not 67 power, and you say, I spent 1 and get 1 back, and you get the same. That's the IRR, is the growth rate. So you're explaining to management, what is the IRR? It's the growth rate. It's the growth rate if you don't take any money out, if you don't have any children or anything like that. Now, so here's the thing I just introduced to you. I put different inflation rates in, and then we get different IRRs. So in this case, I have 10%. Let's put a 1% inflation in, okay? And then that's just the regular old IRR. Nothing complicated, 2 lines. And of course, this is, I said of course, but this assumes this IRR. If you really wanted to compute it by hand, you'd have to basically take this number and grow it by the IRR itself. Excuse me, stick all this stuff at the end with growth rate in the IRR, you get a number at the end, a number at the beginning, and the growth rate would be 11.27 in this case. If we put an MIRR, let's say I use 5%. I'm not going to discuss this MIRR very much. Then we get a lower IRR. If you put 20%, you get a much higher IRR. The problem with this MIRR, it looks like it solves this problem of reinvestment, but it just biases it, in my opinion. I want to show people a high IRR. So let's just put 30% reinvestment rates. Oh, good. I get a higher IRR. Does this mean anything? This is why, if this MIR was the answer that academics sometimes say it is, what a lot of crap. It doesn't work. Sorry about that. Now, let's just take some straight line depreciation. So we take this investment, and this investment, I said, okay, it lasts 20 years. I used Alt EIS, and then I say, okay, well, we have a 50 of depreciation on a straight line basis, the 1,000 divided by 20 years. I'm going to talk about economic depreciation in a minute, but right now we'll use straight line depreciation. This is just I used a choose function because these weren't in exactly the same place. Choose is kind of like the index, right? So I can put straight line or alternative depreciation methods. I guess that's just an input. All right, and then we have our EBITDA, which we used for the IRR calculation. Take away depreciation, no interest, no taxes. That's our earnings. Cash flow statement, we got EBITDA, no repayment of debt or interest. That's our dividend. Not the dividend is not the earnings. The dividend is the EBITDA plus the depreciation, or the earning EBIT plus the depreciation. And then we make a balance sheet. And on the asset side of the balance sheet, I start with our 1,000 in investment, and we bring it down till we get 0 at the end. And then we put our equity balance, and we put our income from here, our dividends from here, and we get our equity balance, which is the beginning plus the retained earnings. Now, the ROIC is increasing over time, okay, just because the investment balance goes down. Enough of that. I don't think I have to show you that. Maybe I should have put that I think I will. Because I'm gonna make a new one. I'm gonna put this kind of ROIC thing. This is what happens. Okay, sorry about this, that you have to see me. Maybe this is being very unprofessional. Oh, no. Oh, God. Okay, whatever. This is going to be this is the growth in the ROIC, but the IRR is somewhere down here. And if we take the average, it gets really high over here. I should have put in that graph, I should have also put the IRR. Okay, that's kind of stupid. Okay, and then if you take that investment balance, this investment, now you go to the beginning, it's really the investment balance at the beginning of the year, because you assume that all the stuff occurs at the end of the year, so it's kind of like interest expense. You do everything on the opening balance. And then you take a discount rate, and the discount rate I used up here is I said, okay, let's take that discount rate, just raise it to this first power up here, I think. I hope you're right. And then we just have our discount factor, and then we take that invested capital and just multiply it by the investment. So we get our PV of our investment. And then we weight that PV, take a weighted average of that PV. You just, not a weighted average, you just take a weighting. And this weighting is better add up to 1. You see down there, it adds up to 1. And then you get the weighted average ROIC, and that's the same as the the IRR. And that's why I used to say, it's all the same. And to kind of demonstrate what's happening with this weighting business, if you have a really big, here's the first investment, you have a balance of here, and you've got 7% on this, but you go down to 15. I think I used the lookup function here to find it. And if I take the average, well, that's kind of silly because that's not what's really, that's 15%. That's not right because the average, if I take all the investment balances and all the EBIT balances, then the weighted average or the average that you really would show on your balance sheet is much less because this one's weighted. This IRR is weighted a lot less. Let's put this as 19, for example, and this is I don't know. How about this is 10 and this is 12? That's just using a lookup, and then we get a 33% kind of raw average. That doesn't mean anything because this investment balance, we shouldn't put a high. That's in our portfolio of assets. That's worth a lot less. Okay, so that's the basic reconciliation, and then I've got this showing you what I just did, and there's the portfolio. Now here's the wonderful thing. It's not really wonderful. It kind of sucks. It's if you compute economic depreciation, and here's how you can compute economic depreciation. You can use the PPMT function or the PMT function. I'm going to show you that in a minute. When you use the economic depreciation and you take a depreciation rate that's not flat like straight line but increases over time, you can make the whole thing reconcile because the whole thing depends on depreciation, this whole funny thing. Now let's put 0 growth rate. Now all I do is put a payment function equal PMT, and you notice that in that PMT function I used the IRR itself. And when you do that, the depreciation increases over time. It's kind of the opposite of it's an expense. It looks kind of like the same thing I just showed you. Okay? And when we do that, then each and every year, sorry, hang on. Just a minute. Okay, I forgot to put my little choose command thing in. Now I'm using economic depreciation with PPMT. And then our ROIC is the same each and every year. Now that kind of works, but it doesn't work perfectly, and I don't know. I used to study economic depreciation in the 1970s. I shouldn't admit this, when there was a whole lot of inflation. Well, maybe 1981, okay. Not quite the 70s. And then if we put 3% inflation, then the economic depreciation doesn't work either. And you get some rates of return that change. But here's what you do. If you put the payment function, PMT function over here, and you start kind of 1 year early and you use a real rate, you use the IRR, divided by 1, the 1 plus the IRR divided by 1 plus the inflation rate, and then you just inflate this PMT, and then you put like a little debt balance. It's almost like a sculpting kind of thing, but the repayment here is the repayment is like a depreciation. It actually starts negative, and if you now do that, that's an even more dramatic increase in the balance. And then you get the IRR. Oops, I got to do that same thing. I forgot to do my little code number thing with the choose command. So we just choose the third one, Okay, and then we get the ROIC is exactly the same over time, and it's equal to the IRR. Oops, oops, oops. Bring up. Okay, now here let me put it back to straight line depreciation for one thing. Now you can say, that just proves it all works. That just proves it all works. But let's just think about things a little more carefully. This discount rate of the IRR, that's kind of like the arbitrary thing. Now, if I put, let's say I've got a 5% discount rate. My MIRR goes to 8.47, but my ROIC, if I do the same business of weighting the average of the ROIC and then do that with a lower discount rate, my kind of weighted average ROIC that I'm really going to get increases. And why should we use the IRR? That's an arbitrary number. Why shouldn't we use 5% in the economic depreciation and the payment function and everything else? And if I use 10%, we get a different IRR. This is kind of, who says that this is wrong? I don't think this is wrong. I think this is almost like a better way to do the MIRR. Now, I'll never get anywhere with this, so it's not worth talking about this, but it could be a theoretical better way to say, here's the true rate of return that doesn't have this distortion in it, because this MIRR doesn't really work. I put 5%, that's kind of the IRR I'm really kind of realizing. All right, enough of that. Although that might be one of the most significant things in the whole lecture. Okay, so enough of that. Let's go on here if I can. Okay, now what happens then? The next question is, okay, I've showed the economic depreciation. Let's put a portfolio of assets together, and this is where it gets painful. It really, really gets painful. And this is where the problems start to begin. And when we put a portfolio of assets, we could either use economic depreciation, which is a confusing concept. Nobody's going to listen to it. Nobody's going to use it. You're never going to be able to restate the financial statement. So why bother almost? It was kind of a little too theoretical. If I use straight line depreciation, I'm going to show you what happens. We have these, it's not surprising. This is the single asset, and this line down here, this little line down here, that's the true IRR. And when you average things, you get a much different ROIC than you get the IRR if you just do this. Now, all I had to do to make this thing work is I make a little model. We start with just the same sort of IRR that I just showed you. This is just a 3-year asset. Let's make a 7-year asset. How about we make a 7-year asset? Now, if I make a 7-year asset, this IRR is way too high, and I put a little, let me see, I put a little spinner box that, this one gets it down fast because it's got an increment of a high increment, and then if, it went too far down, and this one, if you right click on it, it's got a lower increment. Okay, so we put this in, and then I say, okay, well, let's make our first investment. And after we make our first investment, here's the big thing. Now, I hate using this offset because it's something that you really don't need very much. But this time, I went backwards. I say, okay, we're going to retire these assets after we put this asset at the end of year 0. We're going to retire it at the end of year 6. This is a 6-year asset. Okay, because everything happens at the end of the year because we use the opening balance. I have to talk myself through that. But then we have to replace that asset. So we just go and we replace that asset every 7 years. That's why you have that funny kind of thing happening where things go up and down. Now, if you use economic depreciation, the straight line depreciation is flat, Here's the straight line depreciation. So you always have the same EBIT. That looks really good. But the ROI goes up, and then when you make the new investment, it goes down because your net plant is going up and down, just like we talked about before. Now, when you use economic depreciation, I'm sorry about the length of this video, you go to a file on the disk, and you go and you in the corporate, in the advanced valuation issues, I've got some depreciation things, and I've got some depreciation functions here. And this depreciation function, I'm going to press, I copied this into this file, I'm going to press Alt F8, and we put depreciation functions, and it's one of these things that goes through the vintage, because when you keep adding assets, you've got to kind of see when you put them in, and then if you add a bunch of assets and you have a economic depreciation rate that changes over time, you've got to remember what you put in before, and you can do one of these matrices, but that function fixes it. One of the matrices, I mean one of those kind of square diagonal things that you might have seen. If you haven't seen that, just watch. I have some other videos on this, I'm sure, somewhere. Okay, then when you put economic depreciation, you get the same as the IRR. That's the good news. If you could find the economic depreciation, then you can have the IRR. Okay, and then what I did is made graphs of this. Now, when you make graphs of this, you might want not all the graphs to show up. So you make a little if statement and put the NA function in, and when you put the NA function in, you get, hang on, this graph that I just showed you. So if I change this, it's kind of nifty, you know, you see what happens over time. If I make the asset life really shorter, oops, oh, then we got too low IRR, so I better increase it. I'll use my fast increase thing. Okay, right now, I'm kind of not caring about how long the video is. This is really bad. Okay, and we can see the distortion created if we have different assets. Now, one thing is absolutely clear in this example. Whoops, I went down too far. Okay, one thing is clear is that the average does not equal this is the economic depreciation. The average is not the same. If we have a shorter asset life, I've got to increase the IRR again. And this is the kind of thing, I think it's cool to do this kind of thing. You want to do this. The distortion depends on the IRR, the level of the IRR. Okay, and the asset life. If you have a 1-year asset life, then you have no problem. Okay, oops, you know, so when I change that asset life, I've got to put these things in. It's exactly the same. But as soon as you have a 2-year asset life, things start to get difficult. Okay, and let's push this up and down. Okay, so that's the 1-year asset, and we demonstrated we have a problem. We cannot tell management that the ROIC and the ROI is the same for the whole thing. It just doesn't happen like that. Now, it doesn't converge. Now, what happens if well, I made some valuations too here, okay? And since this video is, I'm contradicting myself, since this video is getting a little long, if we really knew the IRR, this is kind of neat. If we can try a valuation, now when you make your valuation, you better put the depreciation equals the capex equals the depreciation. It should have said it the other way. If you don't, you'll get a crazy thing because you're putting an investment 1 out of every 10 years. You better levelize it out. Now, for doing the valuations, I think when you have this corporate analysis, the problem is there's no terminal value. This true valuation goes for like 100, 400 years. And that you can say, okay, here's the true EBITDA and the true capex, no depreciation here or anything else. So this true cash flow just occurs, and we started at different period, and it just goes and on and on and on. Where's the true value and the true cash flow? Excuse me for this. Not showing it now, but okay. All right, this has got the real valuation, at least I hope it does. Now here's the problem, and this one is kind of interesting. If we knew the real IRR that doesn't go up and down, we could value it like a bond. We could go and put in our valuation model, we could say, no, let's do this. Let's take our balance of investment, and let's take our yield, our IRR, and let's say that we just get this IRR and multiply it times our investment balance. Is that what I did? That gives you the kind of stable cash flow after you have to reinvest the CapEx. That's what the nice thing about that is. And then you can discount that cash flow at a different one, and then you get a perpetuity value because we had no increase. So I did that quickly, sorry. But then, if I change the kind of starting period around, I don't know why, and then I change the holding period around, what I'm trying to show you is that I just did a really bad one, okay? Excuse me. Ah, shoot. Oh, that's not so bad that I did that, okay? This kind of knowing what the IRR, I've got a bad example again here, but this helps. It really does. It's a different way to make a valuation. It's almost like making a valuation with a bond, but in the other methods, you get a much higher sensitivity to what happens if you start at a different point and end at a different point. Okay, see, the first thing is going around, okay? Whatever. Now let's go and finish this video. How disaster? It's not that disastrously long. Okay, and then I'm going to now, instead of having this just one asset and you replace it, we're going to move to the case where I don't have any inflation on this, but I have growth rates. So instead of doing this, I said, let's take our initial asset and then let's take our CapEx and just grow the CapEx. Okay, we need to grow our CapEx and we keep growing our company. That's just a growth rate. And I put a growth rate up here of 5%. Now, we also, when we make the CapEx, we have to retire the assets just like we did before. So after year 5 in this case, this is a 5-year asset. Let's make it a 10-year asset. Okay, and it's got the same sort of thing. I've got to lower the IRR a little bit. Okay. And this is maybe a real case. And I want to say, don't worry about that other one. The other one had a problem because we had lumpy assets. So let me go back to the PowerPoints a little bit. So what happens if you have this growth? The real issue is if you have constant growth, you get this kind of stabilizing thing. And does the ROIC converge to the IRR or doesn't it? Can you tell management in the long run, I have this? Now, what is going to happen is that when you start this, you're always going to get, at the starting of the asset, you're going to get a lower number. But then as you get really far into the replacement and the company becomes a mature kind of company where you replace the old ones and make new ones, then it doesn't work either. Here is our economic depreciation, and this is our ROIC with the straight line depreciation. You still get a little bit of an up and down. I don't care about this up and down. What I care about is this does not stabilize right around the economic one. It's a little bit higher for the same kind of reasons. Now maybe somebody could prove that it really does. It gets close. It's not that bad, but it doesn't stabilize exactly. So you put this in, and then I have the same kind of thing with either the case with straight line depreciation or economic depreciation, and then we go and look at our graph, and because I have that NA function, I can put different growth rates in, and I can make the ending value different. So in this case, this isn't that bad, really, is it? It stabilizes at something close, but let's make the growth as 2%. oh, this is not as bad as I thought, actually, okay. But it gives you a little bit higher. Let's make that IRR a little bit higher than the whatever, and then you get a more of a problem. It doesn't equal. This ROIC is getting up to about 25%. The true underlying IRR was 20%. And if you go out further and further, it's kind of cool. You can do this with the NA function. It doesn't stabilize. I kind of wanted it to stabilize and say, so I could throw my hands in the air and say, oh, it's all fine. And you'd have to kind of explain to your management in present value using the IR itself, this present value, which looks like an enormous amount, equals this one. It's a hard thing to do. And if you make the life shorter, maybe you get a different kind of thing, but it's not the same thing. You can't imagine you're using ROIC minus WACC to assess the salary of some poor plant manager. If they're here, you've got to penalize them. If they're here, they get a bonus just because they happen to be at a later point in the life of the asset. And if you're explaining to management, oh my gosh, what's happening, if you if you're explaining to investors rather, my ROE is going up. My ROE is low just because I have a new investment. Are they going to believe you? This is this whole problem. McKinsey says, oh, it's only about ROE, and then we don't get exactly the same thing. And finally, I tried to make a valuation with all this, and the valuation, frankly, if you use the straight line depreciation, it doesn't matter. So you can go and look at this. And I tried to do the same things. I kind of had a little bit of a failure when I did it before. You can change the WACC and you can see. I think these little things, in terms of explaining things, are good. In terms of actually putting it into model, it's horrible. These things can destroy the model because you can't remember where you started with. You almost have to put a reset button in here, which I'll talk about in another video. And finally, I'm just got another case study. This is an airline company, and you get ROEs. They were spending a whole lot on new planes, so their ROE came down when they were spending a whole lot on new planes. But what you really, this is a freight airline business, and anybody who thinks they could make a really high, it's kind of like that solar business. I think you can make a really high margin or high ROI or high IRR in this business. That's what I want to know. How much are you making on the planes right now? And what's going to happen if other people can come in and compete with you and put them down? And how much more is the IRR? But you can't get this IRR really from the ROIC. You have to figure out how old the planes are. You have to figure out when you make the investment. You have to figure out the kind of the depreciation. This is so hard. This is the problem. So this wonderful thing, and I'm going to go all the way up to this wonderful little quote and then stop the video, but this little quote that said, no, everything else is just detail. Remember this, it said, okay, all we have to know is this ROIC versus the WACC. Everything else is a mere detail. Well, if the ROIC isn't equal to the IRR, and the IRR measures the economic value of the assets, that's just our first problem. And this is just the first problem out of thousands, really, in corporate finance. To pretend that you can apply these formulas and do something accurate, what a disaster that really is. And I think I'm going to end the video, and I hope I've explained this concept of reconciliation, but it's this problem that you don't have a clear answer. I'm sorry. I'm so sorry.